Hello. Chapter 15 is option market. So this chapter start. So this is the first chapter that we're going to see the derivative securities. So previous chapters, chapter 10 and 11, we will see the debt securities, sometimes called the fixed income securities, which is the loan, debt, liability of the firm. And the chapter 13, we saw the equity market, equity valuation, which is the stock security, equity security. Now the derivative security is basically the one that whose value is based on the underlying assets. So derivative security itself is security, and it may be asset, but the value itself actually changes not based on its own value, but based on the underlying assets value. So we start with the options first. So chapter 15 and 16, we'll see options, and 17, we'll see the futures and forward contract. So what is option? Option is the right to do something. So this option means you have a right. Right to what? Right to buy or sell. So if you buy options, then it means that you buy the right to buy or sell some underlying security. Usually, make stock option example. That's probably easiest one. So, probably for this chapter, we always talk about stocks, but doesn't have to be stock. Any asset can be used as underlying asset. If you have right to buy, then it means that you have. It is called a call option. So you have right to buy, then you have call option. If you have right to sell, then you have put option. Okay. Put option. So let's see the call option case. The call option, again, the right to buy any asset. If it is stock option, then it's a stock. As specify the exercise price, which is the price that you will going to pay, because you basically will buy, right? This is also called the striking price. So exercise price, striking price is the same meaning. On or before specified expiration date. Now it says on or before. Most options, the feature is you can actually exercise the option on actually by the expiration date. This is called American option. If you can only exercise on the expiration date, it is called the European options. So there's American option versus European option. Common misconception is, well, maybe the option in the United States is American option in Europe is European option, which is not true. The American option is the option that can be exercised until the maturity date, so on or before the expiration date, I mean. The European option, you can only have one day to exercise, to be exercised. So on expiration date, you have to exercise it. I mean, not really you have to, but you can exercise only on expiration date. Okay. Now, because option holder buy the right, there's a seller, right? So this seller is called a writer, option writer. So option writer sell the option to holder, option holder, right? Because option writers sell the option, then option is a right, then you need to pay the price. Option holder need to pay the price, which is called premium. So option itself has value because option is right. It means that option holder make a decision. If option holder says, I'm going to exercise this option, then writer should follow that. The writer doesn't have any choices. That's why there's a premium, there's price, and this price is paid to writer from option holder. So this is example of the profit and losses of the call option. Now consider November 2014 expiration call option on a share of Facebook with exercise prices $80. Okay, so $80 exercise price, selling October 16, 2014. So you have about, I think, the 20 something days left. For 264, this is the premium. So 264 is the premium. $80 is the striking price. The exact expiration date for this option is November 21st. So you have about a little bit more than a month, right? Until then, the call holder may exercise the option to buy a share of Facebook of $80. So they can exercise option by buying shares. Like if they exercise it, they can, the holder can buy Facebook stock for $80. On October 16, the Facebook sells for only $75.95, which means that you basically, if you exercise option, it means you pay $80 for $75.95. You're not gonna exercise it, right? Because you lose money. So because that price is less than $80, it clearly does not make sense at the moment to exercise this option. So it means that if the stop price is below exercise price, then you have loss. So you don't exercise. No. Only is above, then you can exercise. You have profits, right? On the other hand, if the stock selling above $80 at expiration, so it increased, and now if it increased above the $80 expiration date, then the call holder will find it optimal to exercise this option. So if the stock price is above exercise price, then they can actually pay less money for the higher price stock, so they exercise. For example, if the share sells for 82, so suppose ST, which is the price expiration date is $82, exercise price is $80, then the value of this expiration date equals to ST minus X, which is 82 minus 80. So it's $2. So basically the value of the call option is max between the ST minus X and 0. Okay. So if ST minus X is negative, then they don't exercise it, then there's no values, right? So $2 payoff is generated. Now we have to think about 264, which is the price. So your profit is the payoff minus premium, right? And payoff is $2. Premium is 264, so you actually lost 64 cents. Still, you have to exercise it because you can reduce your loss. Otherwise, if you don't exercise it, your profit will be just a 264 premium, right? So if you have stock price of the expiration, the exercise price and expiration, then you have to exercise it and receive the payoff, even though the payoff may be less than the premium. Still, you can reduce your losses. So that's how to calculate the value at expiration and the profit for call option. There's another kind of option called the put option. So put option is the option that gives the right to sell, which means that this case, now you want to have stock price is below exercise price, right? Then you can actually sell your shares at a higher price for the lower stocks. So this case, so if you exercise and you generate positive payoff, you call this option is in the money. So in the money option means if you exercise right now, it generates positive cash flow. It's in the money option. If it does not generate positive cash flow, then it's called out of the money option. So exercise will generate negative cash flow, so you don't exercise it, right? You call it out of the money option. At the money option is simply the exercise price equals to asset price. So what about the profit for put option? Now, similar way, now consider the November 2014 expiration put option on Facebook with exercise price of $80. So X is $80, but now you have put option. October 16, the put premium, so let's say it's a P, it's a $674. Okay. It entices owner to sell the share of Facebook for $80 anytime until November 21st, right? If the holder of the put buys share Facebook and immediately exercise the right to sell at $80, now it's in the money because the stock price right now is $75.95, so it's in the money because if exercise it, then you basically generate 80 minus 75.95 because the payoff, the value of the put option is max X minus ST and 0, actually S. So you can actually you can sell this share. This is actually $75.95, but you can sell it for $80. So you basically can generate $4.05 payoff, but in fact, you actually pay more than that, $674, which is very general because if option is in the money, the price of option increases, right? Because there's more possibility that the option may be exercised. So the premium always greater than the payoff so that you don't exercise it. Otherwise, you get actually arbitrage opportunity. If the put premium is below $4.05, then you just immediately exercise and make a profit for sure. It never happened. So obviously investor who pays A684, probably they don't intend to exercise and wait. If on the other hand, Facebook selling for $72 at expiration date, what happened is now the price dropped more and then the expiration date becomes 72. Now, so ST, expiration date price is below exercise price, clearly is in the money. So the value of the expiration, the payoff is, again, max X minus ST and 0. This case, X minus ST is the 72, actual 80 minus 72 and 0 and max. So it's $8. So $8 is payoff and profit is A minus, so payoff minus again, premium, right? So A minus 674, you make 126. So now you make 126 out of 674 because you basically invest only 674 and you make dollar return $1.26, right? It's actually 18.7% only for 36 days. As you see, the price dropped only by 10%. So 10% changes price actually lead to 18.7% profit. So it means that even though underlying asset value changes by a small amount, the option value, the return for option may change more, like, I mean, in a larger scale, basically, because you only pay premium, not the price of the asset. And premium is a lot lower than the price of the asset. We'll see more detail later on about that. Now, how to trade the options? Now, option is mostly traded in the organized exchanges because it is easy to trade and it may be more standardized so that everybody's just satisfied with these transactions. And I mean, if you're a holder, then you probably concerned that the writer can make promises. So we need exchanges to make sure that our investment is safe. So there are two different types of American option and the European options. Again, the American option can be exercised on or before expiration date, but European option only can be exercised on the expiration date. Option clearing corporation, jointly owned by the exchanges. Now they basically set a standardization of the option trading. So there is a standardized option volume, the expiration date, things like that, and they actually publish the code. If you write an option, then you actually have to post margin, which means that they actually change the value of your account based on the daily price changes, and you need to have the margin to start your option trading. There's different other types of the option, such as the first one is index option. So index option is underlying asset is stock index. So such as S&P 500, Russell 2000, S&P 500, Hang Seng index like Nikkei 225, whatever index, whatever stock index may be the underlying asset. So value of the option change based on the index value. The futures option now, it gives the option on futures. So the underlying asset is futures. Foreign currency option is, again, the underlying asset is foreign currency. So it offers right to buy foreign currency for a specified amount of domestic currency. It's very popular in the foreign currency market again. Interest rate option is option on the T-note bond bills. So the government issued, the federal government issued the bonds and other countries' government bonds. So this is bond option. So underlying asset is government bond. Now next part, we'll see the value of the option at expiration date.